Now back to Inside Real Estate. Here's Mike the Realtor.
Hey, folks, we are back. InsideRealEstateRadio.com is the website. InsideRealEstateRadio.com is the website. Hey, we're going to do a little bit of mortgage talk right now. We got Terri Waggoner, our resident expert in all things mortgage from Supreme Lending. Here, her website, TerriWaggoner.com. TerriWaggoner.com. How are you, Terri?
Hey, I'm good. How about you?
I'm good.
Good.
Happy B Day this past week.
Oh, thank you. Thank you. Appreciate that. 1 year older. That's all right.
That's right.
We're still kicking.
That's right.
Hey, also on those HUD homes, you kind of have to know what you're doing and talking about when you're doing the loan on those as well. So we are extremely well versed in those as well. So yeah, if you're looking into a HUD home, we can certainly help you with that.
Yeah, absolutely.
This morning I wanted to talk about just eligible borrowers. Who's an eligible borrower? How do we know who can go on the loan and who can't go on the loan?
Okay.
So first, obviously, you have to be 18 years old. You have to be old enough to enter into a contract. I have had some really young buyers before, and but you have to be 18.
Got to be 18 at least.
Got to be 18.
I don't think anymore that's a problem. I feel like
no.
yeah.
I haven't had a really young buyer in a while. I do have, people in their early 20s, which is good.
Yeah.
You get out of college, buy a home. That's a good thing.
That is a great thing.
And we've talked about that before,
yeah.
Where, if you're really young and you purchase a home, you can then turn that into an investment property and buy you something else. And there's all kinds of programs that help you get into the home. So it's still a really good time to buy a home, even if you're straight out of college. As long as you're employed, gainfully employed,
yep.
Straight out of college, we can certainly put you in a mortgage.
Very good.
So then let's talk about co-borrowers and who can be borrowers and who can be on the loan and how all that works, because Texas is a community property state. So, and this confuses so many people. I had several people this week that were just confused by it.
Sure.
So if you're married and let's say you want to put the husband on the loan, but not the wife. A lot of folks think we can use wife's income still because I have to count her debt.
No.
You can't do that.
Right.
So because Texas is a community property state, if both parties in the married couple there are not going to be on the loan, if we're doing any type of government loan, I still have to count the debt from the non-purchasing spouse in the debt to income ratio. Mm-hmm. But I don't get to use their income. So why would you not put the spouse on? Well, if the credit's not good enough, there's several reasons why you wouldn't want to put that spouse on there.
Right. Yeah. Maybe there's no real income or not
Right.
enough income to make an impact.
Or it's part-time income and they just started it 6 months ago.
Right.
You can't count that income anyway.
Exactly.
So there's a couple of reasons why we wouldn't put the spouse on there. And I always like to start an application with more information than I think I'm going to need. So yes, we're going to pull credit on both husband and wife and see what we have and see what works best for us in our situation, because every situation is a little different.
Yeah.
But just because we're counting their debt doesn't mean we get to count their income if their credit score isn't high enough. So that's how we deal with non-purchasing spouse. Co-borrowers. You can have a co-borrower that's not necessarily your spouse. You can have a non-occupying co-borrower. I have a couple of those working right now, where mom or dad want to help, their kids or their son and daughter-in-law or whatever. Mm-hmm. They can certainly go on as a non-occupying co-borrower. We can count them. We can use their income. We can use all of their assets as well. Okay.
That's a couple important things to think about too. Like, for example, if you're going to be getting married in the near future and you're not married yet,
good point.
Sometimes it's strategic to purchase the house prior to getting married, because you're right, you have to count the other spouse's debt. So, for example, if you have a situation where one spouse is maybe already in the workforce, established, solid income, but the other spouse now has a lot of college debt and is a little bit behind in age, maybe, whatever the case may be, but they're just getting out of college. All they have is college debt.
Right.
In that case, and maybe their credit score is not that great, not really established yet. maybe one's ahead of the other.
Right.
In that case, you're not married yet. Buy the house first in that person's name, so that way you don't have to worry about the debt. You're going to be better qualified, then get in, and then then you're taken care of before you get married.
Right, and we do that a lot.
Yeah.
One thing I will caution you against: if you're going to get married throughout the process, be sure and let your loan officer know. Don't just bring it on them, the day before closing. Hey, by the way, I went this weekend and got married.
Yeah, I got married yesterday. That's not going to impact anything, is it?
Yeah, don't do that.
Yeah.
So, and we've had that happen before. So, don't go to Vegas and get married or anything like that.
No.
Let us know. So, absolutely, yeah. But we can use we can definitely pull the credit of both and see which works best. And you mentioned before about student loan debt. That is a huge issue with our younger society right now.
Yeah.
A lot of times what happens on those student loan debts is, you've had them, some of them for 4 years, and some of them have accumulated interest. So now your current balance is higher than your high credit limit. And if that's all you have on your credit or several student loans, you're going to have a lower credit score because of that. So we can definitely take a look at that and see what we need to do.
Yeah, for sure.
Okay, you have to have a Social Security number. We have to, there are, I think, a couple of lenders out there that are still able to do loans with those I-10 numbers, but you're going to have a difficult time with that. So we have to have a Social Security number. You do not have to be a U.S. citizen. You can be a permanent or a non-permanent resident alien. We can use foreign income. We've talked about that before.
Right.
So just because you're not a U.S. citizen doesn't mean you can't purchase a home here. We can still certainly help you with that. We just need a Social Security number.
Right.
Let's talk for a minute about arm's length transactions. You may hear that throughout the process. So when you're purchasing a home, if you're purchasing a home from someone that you're related to or that you have a relationship with, if it's your boss, if it's your landlord, let's say you're living in the home and you've lived there for a short period of time and you decide you want to buy it, they decide they want to sell. So that's an arm's length transaction, and we have to set it up a little bit differently. So be sure, especially on those for sale by owners, if you're coming to a loan officer, you need to let them know if you have a relationship with that seller and how that relationship kind of unfolds.
Right.
We had one in our office this week where the brother was buying the sister's house, but neither one of them had lived in this house for a while, and that kind of creates a little bit different of a situation. So be sure, and you're not going to hide anything from your loan officer. Be sure and let them know the whole story so that we can figure out the best way to proceed.
Yeah, disclose everything, because you don't want to have something really stupid kill the deal at the last second or delay it for weeks.
Delay it, yeah. Because, and not that we can't do the loan,
right.
But for instance, on an FHA loan, if you're buying a home from a family member that you've not lived in for 6 months or longer, and we have to prove that you've lived there for 6 months. We can't just tell them that you have. We're going to have to prove it with electric bills, something along those lines. Then you have to have 15% equity in the home. In other words, you have to put 15% down to purchase it. Now, we can use the equity in the home as the down payment. That's a way around that. But let's say there's not enough equity for that. So we need to know all of those things up front.
For sure.
Transactions with family members. We need to, again, make sure we pay attention to all of that. Any type of family transaction, we want to know about that. Even if it's a distant relative, let us know so we can kind of work around that. Let's see. Citizens, we've talked about this. You can be a non-permanent resident alien. There are a couple of loan types where it's a little bit trickier. But one thing that we've ran into a lot lately is folks don't know where their green cards are. We have to have a copy of the front and back of your green card. So if you're looking at purchasing a home, make sure you have that document and provide it for us so that we can include it in the documentation.
Right.
Okay. We can have up to 4 people on a transaction. So if, let's say we have husband and wife and they're newly married, we're going to add mom and dad as non-occupying co-borrowers. That's good. We can have up to 4 borrowers on a transaction.
Okay.
Okay. Let's see what else. Guess that's about it.
Yeah, there's lots of ways to, if you are going to have co-borrowers that are maybe the parents, and maybe the parents are thinking about, are the kids responsible enough? There's ways to do things where you're putting yourselves on, a particular type of deed. Also, if you're, later on in life and you're helping the kids buy a home, there's just lots of different things to do. You can do the ladybird deed. There's lots of different ways to do deeding and property. So get with us. I mean, because we can talk to you about all these different options.
Right.
It gets into a little bit of estate planning, that we kind of talk about some of those things, but hey, we'll get into all that and help you out.
Well, and one thing I did want to bring up on that subject is, like on an FHA loan, those are completely assumable. Mm-hmm. So if mom and dad go on the loan to help son purchase a home, it's not necessarily a 30-year commitment for mom and dad.
Right.
Once son qualifies, he establishes himself a little bit more in his new job, and now he qualifies for the home on his own a couple of years down the road, he can assume that loan without having to do a refinance, which is good because when we're looking at our interest rates, kind of climbing up. Mm-hmm. So in the next couple of years, they may be even higher. So you don't want to refinance and get a higher interest rate. You don't have to do that.
Right.
It's an assumable loan. Mom and dad completely can go off of the loan, and son can assume the full loan all by himself.
Yeah,
all by
absolutely.
Himself.
And people forget about that option too.
Yeah.
Hey, folks, good stuff. Terri, thank you as always. And folks, her website, TerriWaggoner.com, TerriWaggoner.com for all of your financing, Texas cash out, purchase, any mortgage needs, any questions you got, she will take care of you. Folks, we're going to take a short break. Then we're going to come on back with our special guest, Mr. Meckler. Hold on tight. We'll be back.